lead metals analysts calling for $309 silver potentially this year.
With all the chaos in the world in Iran, why is silver going down? I would have expected to the trend, same as gold.
That's what you call painting the tape. That's called MOPE, Management of Perception Economics. Not only do the traders know it, the last thing that the leaders of this country would want to see is gold and silver going parabolic and the dollar collapsing in the face of what we see.
If 90 is the new floor.
You're talking an asset that's never found price discovery because going back as far as you can go, it's been held back.
And you know, I love when people say, do you think silver can get to 3, 4, 500? And I always say the same thing. April 1st, 2026. Gold and silver will be allowed in equity and hybrid funds. Under the new mutual fund category regulations, actively managed equity mutual funds may now use a residual portion of their portfolio to invest in gold and silver instruments, including ETFs and related products, up to roughly 35% of the fund's assets in some cases. That's a big amount of potential money that could be flowing back. Andy, can you give us a ballpark estimate of where you think silver price could be by the end of April this year? Many thanks.
How about instead of me guessing, how about let's talk the lead precious metals analyst for Bank of America said by the end of 2026 that they believe it could be anywhere from $130 to $309 an ounce. So this isn't me guessing. This is the lead metals analyst for Bank of America. And remember, what did Michael Hartnett say? He's their lead analyst, period, whose newsletter is in the many thousands of dollars, who goes primarily to the sophisticated institutional traders. That 25% allocation to precious metals at the expense of your bond portfolio is what he recommends. So you have Bank of America, who by many people's own beliefs, including the late Ted Butler, took over the majority of the short position on COMEX for JP Morgan. At one point, he believed, and I don't know where it is at this point, in the OTC market, over the counter, that they have had 1 billion ounces short in physical silver and between 25 and 30 million ounces short in gold. Have they covered? Are they the ones that are also covering as the price is getting smashed? Maybe. I don't know. But I will tell you that it's odd if it weren't the case, that not only is their lead metals analyst calling for $309 silver potentially this year, but their lead analyst, period, is saying 25% of your assets in precious metals at the expense of your bond portfolio.
When the same bank accused of massive short exposure suddenly tells clients to own 25% metals, that's not a coincidence. It's positioning. As Andy Schectman points out here, Bank of America's own lead analyst is floating a $130 to $309 silver range, while another strategist urges cutting bonds for metals. That's a dramatic shift during a cycle where the Fed is still battling inflation and bond volatility remains elevated. If institutions were structurally short, covering into weakness would be rational, and retail would never see it coming. Next, Andy Schectman discusses what this institutional pivot could really signal beneath the surface.
In other words, sell half your bonds and buy gold and silver is coming from him. That's stuff you never heard, ever, in this industry. So I don't know where it'll be by April. That's too short, but
it is too short.
You know, by the end of the year, you got one of the biggest banks in the world saying it could be over 300.
So without, because this is one of the things I wanted to talk about that I think is going to be a very big catalyst that not a whole lot of people are talking about, and it has to do with April, or at least it begins in April. And that's what I was talking to you about before with India. So we know that India has been a monster importer of metals. I think the last 2025 numbers would exceed roughly about 5,500 or 6,000 tons, the value of about $9 billion. Demand in India, a lot of the same reasons as it is here in the States. We have investment demand, which of course is growing. We have industrial use for electronics, solar, other technologies. What they don't talk about is the impetus of a new law or new laws in India that now allow for retirement funds to invest in metals.
They also use it, it's allowable as collateral. Modi issued some form of a subsidy to build homes with all of them having solar panels.
A major bank telling clients to dump bonds for metals while India quietly rewrites retirement rules should make investors pause. As Andy Schectman points out here, India's imports potentially topping 5,500 tons signal structural demand, not short-term speculation. When retirement funds gain legal access to metals, that's long-duration capital entering a historically tight market. Add solar subsidies and industrial expansion, and you're looking at policy-driven demand layered onto investment flows. For portfolio managers watching global liquidity trends into 2026, this isn't noise, it's allocation pressure building. Next, Andy Schectman unravels why April's regulatory shift could matter more than any price forecast.
Correct.
Some people believe they've imported as much as 800 million ounces of silver in the last 5-6 years, which would by far be the biggest stockpile in the world.
So this is the thing that kind of started making me think, was that starting April 1st of this year, the Securities and Exchange Board of India just had new rules that are becoming effective, where they are no longer going to use the LBMA spot price. They're going to use the domestic exchange spot prices.
And what did I say all along? There will come a time where, and this is a perfect example of it. You know, the word fugazi. People look at what
I taught it to you.
People are looking at what's happening in the West and say it is a fugazi price. That it is a tool of the West to not only accumulate silver for the military-industrial complex, but to hold gold down because of its inverse correlation to interest rates. And in a manipulated interest rate environment, you need to kill the canary. Well, these countries, which during our childhood were third world, are now wealthy, sophisticated, coordinated, and motivated. And they understand the way to beat the West isn't with missiles. It is with financial assets. And these assets, which cannot be printed. You can't print gold. You can't print silver. You can't print copper.
When a major economy stops referencing London pricing, that's not symbolic. It's a fracture in the global pricing system. As Andy Schectman points out here, India potentially stockpiling 800 million ounces, while shifting away from LBMA benchmarks signals distrust in Western price discovery. If domestic exchanges dictate pricing, arbitrage dynamics change and paper leverage loses influence over physical demand. That matters in a world where rate policy and currency credibility are already under strain. Investors should watch who controls pricing power, not just headlines about volatility. Next, Andy Schectman discusses how this shift challenges Western market dominance.
You can't print any of these things, and that's what it's coming down to. And
I'm going to get to that, because you're right, and I'm going to read this, because this is I think an important thing that I do think this is going to be somewhat of a game changer. The Securities and Exchange Board of India is implementing broad mutual fund reforms that matter for long-term investing, including retirement portfolios that use retirement funds to invest in mutual funds. These reforms take place from April 1st, 2026. Gold and silver will be allowed in equity and hybrid funds. Under the new mutual fund category regulations, actively managed equity mutual funds may now use a residual portion of their portfolio to invest in gold and silver instruments, including ETFs and related products, up to roughly 35% of the fund's assets in some cases. That's a big amount of potential money that could be flowing back into
when you add in this kind of catalyst, is the word of the day, catalyst. Did you ever watch Pee-wee's Playhouse?
Of course.
You know, my kids watched it, and there was always the word of the day, and every time they would say the word,
the balloons go on.
Catalyst. When you realize we've had between a 2 and 300 million ounce shortfall for 6 years in a row.
A 35% allocation allowance inside mutual funds is not a footnote. It's capital rerouting at scale. As Andy Schectman points out here, India's 2026 reforms permit gold and silver exposure inside equity and hybrid retirement vehicles, potentially unlocking billions in steady inflows. In a market already facing multi-year supply deficits, incremental institutional demand can shift pricing power quickly. Investors often underestimate regulatory catalysts because they unfold quietly before flows appear in quarterly data. Watch fund allocation disclosures after implementation. Next, Andy Schectman unravels how persistent supply shortfalls amplify this structural demand shift.
a systemic, if you will, shortage that seems to be growing. And at the same time, you have applications that are accelerating. It's one of the neat things about silver as a commodity, its plurality of uses in things such as solar panels, in military applications, in monetary
In EV, in
applications,
AI,
and everything, medical applications, and so it is a asset that is increasing in demand and applications, while in nature it is decreasing. As Keith Neumeyer will tell you, it's coming out of the ground at 7 to 1 after 5,000 years of coming out of the ground at 16 to 1, the one being its relationship to gold. And real quick, by the way, this ratio that everyone's focused on for a long time was somewhat of the impetus behind Bank of America's call for $300 silver, in looking at a ratio, realizing that mathematics, that ratios, that long-term established ratios, the further away you get from them, the greater the magneticism that pulls you to the center, to the mean, to the average.
Magneticism.
Magnetism.
Another good one.
Thank you.
Word of the day.
Yes.
You know, the
That
other
can
thing
only be
that,
one word of the day.
well, we can have two.
No,
All
only
right, fine. So we're sticking with catalyst?
Yeah.
All right. The other thing that's good, that's important to know is that, and most people I don't think know it, is that most of the low-hanging fruit is gone with silver.
Of course.
It's gone. So
A shrinking geological ratio quietly says more than any headline price target. As Andy Schectman points out here, silver now coming out of the ground at roughly 7 to 1 versus gold, compared to a 5,000-year norm near 16 to 1, signals structural tightening. Meanwhile, industrial demand from solar and defense keeps rising into 2026, even as above-ground stockpiles thin. Ratios tend to mean revert over long cycles, and when they do, price adjustments can be abrupt. Long-term investors should watch supply math, not social media hype. Next, Andy Schectman unravels why the low-hanging fruit narrative matters for future production costs.
So roughly about 75% of the silver that we get now every year, it's a byproduct. So no matter what we do, you can't just mine greater, heavier, more for silver and expect that the outcome's going to be the same.
That's the impetus behind the government placing state-sponsored price floors, because you have to have it high enough to incentivize miners to dig deeper, go further, because to your point, silver is found near the surface. It's called epithermal,
Right.
like your skin is epidermis.
This
Big
is epithermal.
deposits were found
Right.
forever ago. So why would you impose a state-sponsored price floor? To incentivize miners to dig deeper and go find it. Because to your point, between 70 and 80% of all the silver mined or that comes to market, of the 850 million ounces, which means between 5 and 600 million ounces, come from companies mining primarily lead, copper, zinc. Those companies have no financial incentive to go looking for silver. They're looking for something else. And hey, we found some
Correct.
silver, right? And so that is one of the issues. So to get a company like First Majestic, whose primary mission is to find silver, to dig deeper and go further, you need to make it economical. And that's why they're doing it.
And that's it. All right, let's we went on enough rant for the catalysts, but yay. We should next time we should actually we'll do a drink. Yay.
Here's the uncomfortable truth. Most silver supply doesn't respond to silver prices at all. As Andy Schectman points out here, roughly 75% of annual output is a byproduct of lead, copper, and zinc mining, meaning higher silver prices alone won't instantly boost supply. If base metal demand slows in a weakening global economy, silver production can tighten even further. That dynamic matters for portfolio risk planning, especially with commodities tied to industrial cycles. Investors assuming quick supply relief may be misreading how mining economics actually works. Next, Andy Schectman discusses why production incentives shape long-term price stability.
All right, let's see. So we have Expos John 2180. With such a shortage of silver, do you foresee anything but a delivery failure by COMEX?
A delivery failure would be masked as a cash settlement,
Correct.
force majeure. It certainly could happen. I mean, you could argue that what you see by 4 glitches is almost the admission of that answer. But, you know, these exchanges, the CME, the primary shareholders are the big banks. So, you know, it's kind of like they don't want to fall on the sword, so they'll figure out ways to screw the the contract holders. Like if you look when they had that glitch the other day, they invalidated all of the contracts that were written at that day. And so, the whole thing is a screw job. You could argue we're very close to it, but to actually see a failure is something that a lot of things would have to go bad for that to happen. I would say a force majeure cash settlement, which is the same thing, is more likely. Maybe you see it in London before you do.
When exchanges glitch during volatility, it's rarely random. As Andy Schectman points out here, a formal delivery failure might appear instead as force majeure cash settlement, protecting the exchange before contract holders. The CME's ownership structure, dominated by large banks, creates inherent conflicts when physical tightness meets leverage paper markets. History shows that during stress events, think March 2020 liquidity freezes, rules can shift quickly. Investors using futures for exposure should understand counterparty risk, not just price charts. Next, Andy Schectman unravels what a cash settlement scenario would mean for physical holders.
90 is the new floor. I don't know if it's the new floor. I mean, I would like to think that we have a new floor kind of set in, but I don't know if 90 is it. That means that we wouldn't break 90 because we just broke it today.
It's in a trading range, let's say between
75 and 95 right now.
Yeah.
And I think and I think that that's a pretty healthy range right now. I mean, I'd like us to not see a 7 handle again on silver. I don't think that we necessarily will unless something, I think, catastrophic happens. I believe that, in the mid 80s, high 80s, low 90s is where we should be before the next move up. And I do think that we're going to see a very healthy another leg up. But again, it always has to happen gradually. I think that's the way the healthier move is a gradual move up, not something that's parabolic again. Parabolic just means that we're meeting.
Exciting, though.
It is. But, look, exciting is, how many times did you tell me you're going to wake up one day and see silver up $5? Mm-hmm. We're going to wake up now. Do I think that there's an opportunity where one day that we wake up and we see silver up 20? Yeah. 100%.
50. 100,
yeah, without a doubt.
Trading ranges tell you more about market structure than bold price predictions. As Andy Schectman points out here, silver oscillating between roughly 75 and 95 suggests consolidation, not collapse. Healthy bull markets often stair-step higher rather than go parabolic, especially with macro uncertainty around Fed rate policy into the next meeting cycle. A gradual base in the high 80s would reflect institutional accumulation rather than speculative blow-off. Investors chasing vertical spikes usually enter late and manage risk poorly. Next, Andy Schectman discusses the probability and implications of a sudden outsized upside move.
So I think that it is. It's just a matter of...
You're talking an asset that's never found price discovery because going back as far as you can go, it's been held back.
And, I love when people say, do you think silver can get to 300, 400, 500? And I always say the same thing. You can't get to 300 before you get to 200.
Before you get to 100.
So for me, we've been to 100. So we got there. Now, in my mind is, let's get to 2. And then we could start worrying about the 3s, the 4s, and beyond. But
remember,
right
Bank
now,
of America says $309.
I sure do.
By the end of this year, they
know.
could see it going.
Yep.
Now, that's under unusual circumstances, but so it's coming out of a big bullion bank that's saying that.
All right, this is one of my favorite questions ever. Buy now or wait for a dip?
Cost average instead. Take the amount that you want to buy, divide it into 2 or 3 or 4 or 5, and just start buying in increments.
And here's what I would say, because we may have a little differing of opinion on this. I do. I mean, because I do dollar cost average because I buy every 2 weeks, although sometimes I get a little bit impulsive, as this weekend, and I did it again.
Silver's path to discovery is more like a staircase than a sprint. As Andy Schectman points out here, you can't reach $300 before revisiting $200 and $100. Price discovery unfolds step by step. Bank of America's $309 target under unusual circumstances highlights how even major institutions hedge optimism with caveats. Dollar cost averaging becomes a practical strategy for investors, balancing impulsive entry with long-term accumulation. Relying on headlines alone ignores structural market realities and incremental progress toward true market valuation. Next, Andy Schectman discusses how disciplined incremental buying protects against volatility while capturing long-term gains.
But I will tell you this: if you believe in both metals, and you think that longer term it's going to be there to protect you, to be that insurance, and to be that wealth, I can tell you this: I've been in finance for 20 some odd years. Timing the market, it's a fool's game. 99%.
Price takes in a bull market. Price takes care of entry. It doesn't matter where you go in. Waiting for a bottom is pure luck, unless you're J.P. Morgan, of course, then you know how to do it. But the
You
rest
create
of
your
us,
luck, right?
if you believe, as I do, this is a bull market, then the momentum will take care of your entry point.
And by the way, bull markets are one thing when you're talking about equities, but there is, as I've been told, and not just by you, there is no bull market like a commodities bull market. And they can last years, they could last decades.
And the biggest reason is the absence of a secondary market. When the price moves at a level that catches everyone's attention, no one wants to sell to go back into dollars and into the fiat system unless they need to. And so you have a system where when the mints run out of product or glitch, that there is a absence of investable product. And, the people who actually own gold and silver are such a small minority that if it really did expand into the mainstream, you have no idea what a bull market in this industry would look like. I don't think anybody does.
Bull markets in silver and gold behave differently than equities, and the data shows why. As Andy Schectman points out here, 99% of price action in a commodities bull will naturally govern entry points, making attempts to time the bottom largely futile. The scarcity of investable product, coupled with small ownership penetration, means momentum drives participation more than speculative timing. Mints selling out and glitches are structural signals, not anomalies. Understanding this framework is critical for long-term investors who expect sustained appreciation rather than flash profits. Next, Andy Schectman talks about why mainstream expansion could ignite unprecedented buying pressure in precious metals.
With all the chaos in the world and in Iran, why is silver going down? I would have expected to the trend, same as gold.
That's what you call painting the tape. That's called MOPE, Management of Perception Economics. Not only do the traders know it, the last thing that the leaders of this country would want to see is gold and silver going parabolic and the dollar collapsing in the face of what we see. There's a lot of management of perception going on. So this happens, as you might not have seen this at the beginning of the show. This happens if you go back and look at every single conflict that is broken out, every single one. It's exactly what happens right at the onset.
It's almost like the inverse of what you would expect.
Of course it is.
Happens. And, listen, right now we have the futures are trading right now. We're back up to just about 91. This is all smoke and mirrors.
It's gone nowhere. They knock it down, but they're not only are they expending firepower, but they are at what expense? They are losing trust in the integrity of the system. And Jim Sinclair always used to say, you beat these guys by standing for delivery. And I don't think we can do this. There was a financial advisor in Minnesota that did that with all of his clients and bought 100-ounce bars, took them off the exchange.
Markets often move opposite of expectations during geopolitical crises. As Andy Schectman points out here, silver declining while gold trends higher illustrates management of perception economics, where authorities suppress parabolic moves to protect currency integrity. Traders witness this, yet public messaging rarely reflects it, creating false signals. Futures bouncing near $91 masks systemic manipulation and trust erosion in exchange mechanics. For investors, understanding these subtle interventions is key to navigating volatility and avoiding reactive losses. Next, Andy Schectman shows how standing for delivery remains one of the few defenses against market manipulation.
I got to know real well in St. Paul before I left, and but I'll tell you who can do it. Sovereign entities can do it. Sovereign wealth funds can do it. huge institutional traders can do it. And that is what is happening. So,
Standing for delivery, I kind of equate to when you own stock and when you own a stock and you leave it at
The
Morgan
DTCC.
Stanley. Well, if you leave it in Morgan Stanley, Goldman Sachs, or any of those, and you leave them in street name, that's what gives people the ability to actually borrow the shares from Morgan Stanley or any of the brokerage firms.
Which is the entire concept
Correct.
of the Great Taking by David
That's
Rogers Webb. Because when you leave your shares, as everyone does, it goes to a place called the DTCC. It's
Right.
where everything is
Depository Trust Corp. That's
right.
what it is.
And they then can lend it out. And it stood the case law in the Great Financial Crisis, where if they lent it out to an entity to short, then that entity goes bankrupt and the share disappears. They're not able to pay it back, in essence, that you are subordinate to the company, the custodian who lent it out. They have primary over you, which is absolutely ridiculous, but it is true. That's the David Rogers Webb Great Taking. And if you haven't watched it, go to YouTube.
They can listen to it. Yeah, it's an audiobook.
Yeah.
Ownership in name only carries hidden risks that many investors overlook. As Andy Schectman points out here, leaving silver or stock in street name allows custodians like Morgan Stanley to lend your assets, exposing you to counterparty failure as seen in the 2008 crisis. Sovereign entities and large institutions can withstand this, but everyday investors cannot. Understanding how DTCC lending works and its precedence in financial crises is critical for anyone holding physical or paper assets.